Well, it's January the 29th. I guess the political world is, well, one executive order after another, but I don't know if anything hot or interesting is happening on that right at the moment. But there is something that's kind of hitting the news lately that a lot of people might be interested in. Certainly, Rush Limbaugh was talking about yesterday, and that's this whole GameStop, and other, stocks, AMC and so forth, all the volatility and having to do with hedge funds and short selling and that sort of thing. And I thought, well, that might be an interesting topic for people. I don't know, the audience here exactly its sophistication in these sorts of subjects. So I thought, no, it might be good. At any rate, again, like and subscribe to these videos if you want to keep them coming, and inform anybody else you think might be interested. I'm trying to grow this channel. And comments are appreciated if you have any. Okay, let's get on with what happened here. First of all, it involves hedge funds and short selling and so forth. Okay. Hedge funds are a particular type of financial fund, sort of like mutual funds, except these are kind of more restricted membership. They generally are for clients that are prepared to take on higher risks and have a lot of assets. So they're considered to be kind of funds for the rich. And one of the interesting aspects of it is they're allowed to sell short as well as go long and invest in a variety of other financial instruments that maybe your typical mutual fund isn't allowed to mess with or something, or at least typically doesn't. I'm getting the laws on that. But okay. So, first of all, define short selling for everybody to bring everybody up to speed. The essential idea of short selling is the following idea: that since stocks go up or down, it might be interesting to see if you can make money when you know something's going to go down. And so the technique is basically done the following way. First of all, it has to be done in a certain account. So you have to have a margin account to do this sort of thing. So your basic cash account isn't allowed to do it. Okay, that's another thing to think about here. And what you do, let's imagine you have a stock at $10 a share. No, it's just XYZ, a particular stock. And you think it's going to drop, maybe to $5 a share at least. And so what's done is you put in a short order, and what actually happens is that the firm borrows the stock from somebody that actually owns it, and then sells the stock. And what you have to do is you have to basically put up what's called margin money, which is usually about half of the price of the stock, and then you have to do what's called mark to the margin. So if it goes up to 11 or 12, instead of going down like you think, you have to put in additional money to cover the losses, okay? And then if it goes down, of course, the margin you're winning and you're making money, all right? And the idea of it is if it goes down to $5 a share or whatever your target is, then at that point you buy the stock back, and that way the stock is then transferred back to the account from which it was borrowed from, and there you have it. You've made 5 points, and if you had 100 shares, that would be $500. And of course, if you had 1 million shares, well, if we're talking hedge funds, so you get the idea. I think it's just the opposite. It still has to do with buying low and selling high. It's just it's time reversed. You're selling before you're buying, but the same profit mechanism's there. Okay, so what's going on here with the GameStop situation and some of these other companies were companies that the professionals thought were going to either go bankrupt or really go to ultra low levels. And so what they did was they piled on and shorted these things massively. Okay. And these are big hedge funds that have a lot of shares, and they're trying to basically, it has the effect of waiting for these things to actually go bankrupt or drive way down. Like AMC Theaters was at a very low level for a while, I think, because not many people go on the movie right now and so forth because of the virus and so forth. And I don't know what was going on with GameStop. I don't know much about it specifically and have no recommendation about it, needless to say. I'm just saying that that's what they thought. Well, then what happened was a bunch of people on a website all said, hey, this thing has so much short interest in it. If we all start buying it, we could put these people in a position where they're going to have to buy it back, and we'll drive the price way up and we'll make a lot of money. This is generally referred to as a short squeeze. Okay, because remember, they've got to cover mark to the market with cash as the thing goes above their initial sell price. And these funds had a lot of money in, apparently, in this strategy, and were totally caught with surprise that somebody was going to have organized buying against them. Okay, because normally that wouldn't happen. Normally you'd look at the thing and say, yeah, it's going bust. I'm not going to buy that thing. I don't want to throw my money away. But these people bought it and probably bought options also. And so the result is, or some of them did. And so all of a sudden what happens is this buying just totally drives the price up at this point. Because nobody's selling anymore, because most of the people have sold, and the short selling was done at a much higher price. So all of a sudden the stock just goes way, 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 way up, and now these funds are losing massive amounts of money, and they're having to cover for it. And that's essentially what went wrong. Or right, or how you want to look, and it caused a bit of a fiasco here. And what that leads to is now these funds have to raise the money, so they have to do something to get the money, like maybe sell other stocks they have that aren't even involved in any of this volatility, just your mainstream blue chips or whatever in their investment portfolios. And they're selling these in order to raise the cash to cover their losses on the short sale they had on GameStop or AMC or whatever company was in this fiasco. And so that's having the effect of driving the overall market down. And that means if you're just in your 401k with your relatively safe S&P mutual fund, you're feeling pain now too, not just the hedge fund. So it's not really big versus small totally. This is disruptive to the market. And the brokerages in question are having such volatility in the transactions that they're actually worried about, being able to make the market in these things. And so at some point they want to shut off the buying just because they don't want to be at financial risk either. And by the way, excuse me, but by the way, while this is being portrayed as, David versus Goliath, or good guy versus bad guy, it's not quite that simple. The fact of the matter is this is irrational volatility in a stock that probably is pretty close to on the verge of, well, I don't say, it certainly is not anything like at the valuations it's at now, because of all this incredible speculation that's going on. And now, of course, then you get actual day traders get involved in it. When they see this volatility, they may not even be part of the short squeeze scenario. They simply see a rapidly moving stock, and if they're quick on the trigger finger, and if they can get in and out quick enough, they can grab a piece of the action too. Between because it's moving so fast. If you look at the chart on like CNBC, it's just it looks sort of like somebody having a heart attack or something on an EKG or something. I mean, it's so the point is, this is a situation here. And by the way, this is not like, this is being portrayed like this is some kind of one-off, got the poor guy. This is very normal when you have excessive volatility in the stock. It's very normal for brokerages or even the SEC to put various trading restrictions on that entity. I guess all the people are going to get in it and exploit it for various political purposes right now, but it isn't quite as unfair as you might think it is in some ways. And remember, the purpose, I think, the real purpose as I see it, is to try to restore some stability. I mean, in my rather conventional investments, I've been losing money since this has been happening, and I have nothing to do with GameStop at all, but obviously it's affecting other, entities that are involved in it, and they're selling things to address other situations they face, and also, and the market, well, maybe, it's been up at pretty high levels right now, and I don't think there's put it this way, I don't think there's anything the administration's done since it's been in office that's been very good for the economy. So we can judge whatever we want from that. As people who are not registered financial advisors should say, this is not financial advice. Talk to your professional or whatever. So that's kind of what I had to say about it, to understand what's going on here. And I suppose we'll have a congressional hearing, a lot of, claims of this and that. But I'll give you an example of how sometimes this sort of thing happens to billionaires too. Years ago, I think that's like in the early 1980-ish, I can't remember the exact date I recall, there was a guy named Bunker Hunt, no relation, and at least not that I know of. At any rate, he's the son of H.L. Hunt, the oil tycoon from many years before that. And anyhow, he got the brilliant idea of trying to counter the silver market by buying up all these futures in silver. And he drove the thing up to a very high rate, at which at the time I believe was somewhere, I forget exactly how high. It definitely was above $20 an ounce, and I can't recall exactly. But at any rate, it got to a very high level. And what happened to him was that they basically, the futures market made a ruling that you could raise the margin tremendously on buying and essentially left it like it was for selling, asymmetrical, which meant that the buyers had to cover their positions and sell, and the short people could jump in and sell. And of course, his $10 billion profit was wiped out very rapidly, along with, of course, all the people that actually had old silver coins that they were turning in to be melted down for sale too. So, but mainly it was to prevent him from cornering the silver market and walking up and forcing delivery of silver to people that didn't have it to deliver. And there's a lot of, I'm just saying, he got wiped out with the same kind of maneuver. So it's not unprecedented for things like this to happen, which suggests, you know, as I understand, they're not necessarily denying people the right to sell the GameStop, if I understand it right. And again, not a recommendation, but I think they might be trying to save some people from losing their money if they jump in at these levels and with these kind of volatilities. Because obviously there's probably nothing on the fundamentals that justify the price at the time I last looked at it before I began this video. You know, so that's the kind of thing you're dealing with there. And I just thought I'd put this out and see if this is interest to anybody. Is topical. And so I think I'll close this for now, and we'll see what topic comes up next.